This is Ringler Radio, where you get all the latest news and information about structured settlements from Ringler Associates, the first name in structured settlements, helping injured people and their families since 1975. Ringler Radio is made possible in part by Allstate, American General, John Hancock, Liberty Mutual, MetLife, Mutual of Omaha, New York Life, Pacific Life, and Prudential. Now join Ringler Radio host Larry Cohen.
Well, hello and welcome to Ringler Radio, everyone. I'm Larry Cohen, head of Ringler Associates Northeast Operations, and we're certainly glad you could join us today. Well, today on Ringler Radio, we have a very special and interesting show. Our guest wrote an illuminating opinion piece spotlighting Warren Buffett, life companies, and the benefits of structured settlements. The article, written by Brendan Lynch, is titled, "What Does Warren Buffett Know That You Should?" You can read it at lifehealthpro.com, but we're going to talk about it here with Brendan today. And to help me do all that is my co-host and Ringler colleague, person I've known for an awfully long time, my friend Bobby Steele. Bobby's been in the structured settlement industry since 1978. He began the program for one of the first life insurance companies to specialize in structured settlements, and he was a founding member of the National Structured Settlement Trade Association. And he's also served on its board of directors. We go back quite a ways, Bobby. Welcome to Ringler Radio.
Well, thank you. We do go back a long ways, and that's why it's an honor to be here with you and with Brendan Lynch, who I have gotten to know very well over the last few years, and I respect highly. So it's my honor to be here today, Larry.
Well, that's terrific. And speaking of Brendan Lynch, he is our special guest today. Brendan is the former president of institutional products at Travelers Life and Annuity. And in 2005, he retired after 37 years at Travelers and currently provides investment advice for life insurance companies and provides us with lots of advice by serving on the board of directors here at Ringler Associates. So, Brendan, welcome to Ringler Radio.
Thank you very much. I appreciate being here. I've thought of this venue over the years as a terrific place for concise, to-the-point discussions on issues relating to the industry. So I think it's a terrific venue.
Well, that's good. I'm glad you see it that way. And today I think we're going to have a terrific show. So let's begin. Brendan, give us a little bit about your background and your current role. It's quite an interesting story. Why don't you tell us about it?
What I do now is when I left the Travelers, I joined Ringler's board, and I'll talk about this a little later, which was an enlightening experience for me and continues to be that way. I had been responsible from the sell side at Travelers Life for structured settlements, but now I get to look at it from the buy side, so it's a very interesting dynamic. Additionally, I serve on a lot of purely Mercenary boards in the greater Hartford area, so I'm keeping myself out of trouble.
That's for sure.
Well, Brendan, we're here today to talk about your fantastic article, and again, the title, What Does Warren Buffett Know That You Should? I thoroughly enjoyed it, and as someone from the same life insurance background as you, I just thought you made so many good points. Warren Buffett is many things. He's an American businessman, an investor, and even a philanthropist. Why did you personally decide to write about Warren Buffett, who, as we all know, is the CEO and chairman of Berkshire Hathaway? Do you find that people trust his business sense for the most part?
Well, let me take a step back. I think that was a great tagline for the article, but I don't pretend to understand what motivates Warren Buffett, nor do I understand and anticipate his investment strategy, whatever it may be. But I understand that he has a reputation, and well-deserved, as an astute pension investment for the long term. And he has a total track record to prove that. But the article itself is my opinions on how to approach the investment and the product compositions in life companies. So rather than anticipating Warren Buffett, let's focus on the on the strategic things for life insurance companies.
Well, you know, Brendan, it's always good to have people read whatever you write, and I think that title really caught people's attention, and I think that's a good thing because it brought people to learn and read more about the meat and potatoes of what you're trying to say. But right at the beginning, right in your article, right off the bat, you say that one person who's figured out the benefits of structured settlements is Warren Buffett, because in recent years, Berkshire Hathaway has moved aggressively into structured annuities, capturing about 15% of the total market in 2012. And in an environment where some life companies have gotten out of that business, that's quite telling. So tell us about that and what it means to you.
Yeah, clearly his emphasis on long-term investing has been a trademark for him. And he certainly lives up with that in his pursuit of long-term liabilities that the structured settlement industry offers. He's a patient investor. The funds from structured settlements provide him with liabilities that give him long-term assets to enhance the profitability for his organization. So it's structured settlements, in my mind, is a good fit with Warren Buffett and his approach to the markets.
Well, and also, historically, he doesn't make a lot of mistakes in where he tends to put his focus. So that should kind of tell the rest of the industry something about structures. And in the article, you also talk about some of the reasons why life insurers in general should think about starting structured settlement annuity programs in this investment environment. Tell us about some of those reasons why you think insurers should look hard at structures.
Yeah. I think we all hear from investment advisors on a personal level about diversity in asset classes as we approach retirement, some of us closer than others. But the same for insurance companies is true on diversification of liabilities. History has clearly proven this out. When you look at the GIC problems that the insurance industry has had by focusing on too short liabilities. Mm-hmm. So when somebody like Buffett pursues long liabilities like structured settlement, it allows the company to participate across the entire yield curve. And additionally, structured settlements, like other products, eliminate the disintermediation risks that are inherent in retail annuities, etc. So that can have, in turn, a powerful effect on product development within a company and allows them to be at all the points, both from a product standpoint and from an asset standpoint, across the entire yield curve.
Good.
Brendan, I find it very interesting. We all know the great reputation that Berkshire Hathaway has. I find it very interesting that they have become a major player in our industry just in the last 2 years as interest rates have been at an all-time low. Does that tie in with what you're talking about, long-term liabilities and, being able to grab those liabilities when interest rates are at this point?
Oh, clearly. When you can sell long liabilities and use time to enhance the value, absolutely the time to be in the market.
Agreed.
Absolutely. Now, everybody talks about improved liability and growing their base in the insurance industry, but those are not necessarily complementary. Sometimes you can be profitable by shrinking product lines, etc. Mm-hmm. This is classic Warren Buffett, where he really resonates. He's managing his various businesses like a symphony orchestra. He's utilizing under and overcapacity within other lines of business to aggressively go in to accumulate long assets in a low interest rate environment to be using that money over a significantly long time horizon.
Well, you also like to talk, Brendan, about managing the liability side of the balance sheet to enhance overall profitability and manage risk. Why is that an important point, managing the liability side?
Well, I don't think anybody wants to be caught in one point in the yield curve and be subject to claims on the assets. So long liabilities opens up a full range along the asset compendium, using non-traditional assets such as real estate, private placements, even equity and private equity. So, you can go to places in the asset world that are not necessarily tied to what people would consider conventional. So the long liability gives somebody like Buffett a real opportunity to enhance their product offerings and, of course, enhance profitability.
No question. And, as interest rates inevitably will rise again, as Bobby, you said, it bodes well for profitability into the future.
And Brendan, you've made some great points here, and we would all, I think, agree that we would, really love to have the results that Berkshire Hathaway has had over the years. So I know with you being in our industry for so long and so experienced, you've probably gotten the common question, what can we do to improve profitability and grow our business? Is there anything you'd like to add to what you've already stated here to address that?
Well, the only thing I'd add to what I said is that, as you approach lines of business, you need to understand that businesses interact and that you shouldn't be focused on one business or one point in the yield curve, because nobody can predict the future. So what you want to do is balance. What you want is assets and liabilities in balance. So that's the key to profitability. And again, Buffett is a long-term investor. Many people are not that way.
It's funny you talking about predicting the future. An old friend of mine once had a phrase I liked. He said, "Yesterday is history, and tomorrow is a mystery."
There you go.
That was kind of fun. Well, let's take a quick break right now and be back in just a minute, right here on Ringler Radio with Brendan Lynch and Bobby Steele. We'll be right back.
This is Ringler Radio from Ringler Associates, the leader in the structured settlements profession nationwide. Did you know that Ringler is involved in a third of all structured settlement cases in the country? Ringler Associates works with all the parties in a lawsuit settlement to find the best possible financial solution for the people involved. When it's your interest at stake in a lawsuit settlement, you want only the best financial plan. You can count on Ringler Associates to structure a customized plan that meets the needs of you and your family for the future. Visit ringlerassociates.com to learn more. There's a Ringler Associate in all the major cities of the U.S. No one has more experience than a Ringler Associate. Check out our new website at www.ringlerassociates.com for the best information for claimants, legal professionals, and claims personnel, and to find the Ringler Associate nearest you.
Welcome back to Ringler Radio. Glad you could join us. I've been joined here by my co-host and Ringler colleague Bobby Steele, and we're talking to Brendan Lynch, former president of institutional products at Travelers Life and Annuity, and currently an individual who provides key investment advice for several life insurance companies and also serves on the board of Ringler Associates. Well, in your article, Brendan, you talk about a striking similarity between the structured annuity business and the institutional pension annuity market. Tell us about that.
Yeah, I think the similarities are pretty obvious. Both of them offer reasonably long fixed liabilities and defined payment streams. So pension liabilities are somewhat smoother than structured settlements which are lumpy, but because most of these pension buyouts tend to be focused on immediate life annuities and things of that nature. But what they do together is to level out that what I talked about, the points in the yield curve. It levels it out. The pension liabilities are what I would say midterm because of the measured on a duration basis. They're shorter. The structures continue to take care of the long end of the asset curve. So an investment manager can really utilize the whole curve and take advantages where the opportunities are. So I think they're very similar. Sometimes they have different motivations for doing it, but what you're seeing now is a lot of activity in the pension buyout arena.
Interesting. Bobby, before we move on, you've been in the structured settlement life side of this business for quite a while as well. Isn't one of the major differences, though, between the pension annuity market and the structured settlement annuity market, the fact that a lot of these structured settlement claimants are injured individuals and sometimes get these age ratings by medical underwriting? And if you guess wrong on that, if you get too aggressive on that, it could come back to bite you. How do life companies deal with that issue vis-a-vis the pension market?
Well, and it's a great question. A couple comments. First of all, Brendan talked about the lumpiness of structured settlements, and as we all know, individual structured settlements can be lumpy with starting dates and future lump sum payments. But the more structured settlements you write as a block, they tend to become very smooth as far as what future liabilities are. I think one great point that Brendan made in his article was how workers' compensation claims dovetail with pensions. Workers' compensation claims typically make payments until a claimant reaches age 65, and then pension annuities typically begin when the annuitant turns 65. So we're trying to have predictable, smooth liability streams. It sure is nice to have a smooth liability payment side of the equation with all these workers' compensation benefit payments being made up till age 65, and then at age 65, here comes a lot of pension payments coming out, so it smooths that whole liability side of the equation. Then to finish up with your question, it's kind of the same thing with the underwriting. You're talking about rated age and what happens if you don't get that just right. Well, on an individual case, of course, you can be way under or way over. But as you write more and more structured settlements, it's the law of large numbers. You aggregate those liabilities, and as a group, you will be where you should be from an underwriting perspective, or hopefully slightly better.
Well, Bobby, I think those are wonderful points. First of all, as Bobby indicated, you've taken out again, go back to the Warren Buffett like a symphony orchestra. If you take workman's comp annuities that are paying up till 65 and then kicking in the pension liabilities, what you've done is eliminate the reinvestment assumptions that you would have had to make for the pension liability as you put the two products basically side by side. And don't lose sight of the fact that a large motivator in the cost of pension liabilities is the mortality assumption. So they're not without mortality risk. Admittedly, on structures, the mortality risk, is more individually underwritten. So in total, I think it balances. The problem is you have to have committed, like Warren Buffett does, to the business to capture those large numbers that Bobby talked about.
And Brendan, that's a great point, and you kind of discussed that in your article. When you talk about structured annuities and commoditization, I think that word is maybe a little confusing to some people. Can you explain what commoditization is for our audience?
Yeah, I very simply, I mean, if you look at like buying gasoline, you're not concerned about anything in reality except the price. So that's a commodity. Price dictates. You can control the markets by pricing. To a large extent, not totally, I think structures and pension annuities may be in the same boat, but there are subtle differences, and I think there are important differences. Security is one motivator that creates a subtle difference. And in the structured settlement world, again, as I said, Ringler has been so kind as to educate me about the structured world. And truly, the service that's provided there is a differentiation that moves it away from a commodity. So, yes, there is an element of that. And if people are motivated only by price, it's a commodity. But if people recognize the value of services, etc., then I think there is a differentiation.
You know, they used to call gas stations service stations, and that's what structured settlements are, really. One of the elements, as you point out, is how you service that, how you sell the product, how you service the product, and that has a value at the backside. But as Bobby has often said, you know, the strength of the life company that you're placing the annuity with is critical as well. So all of those elements balance together to make the business work. And if you have someone like Warren Buffett, for example, who looks long-term and is willing to ride out some of the ups and downs, that's a pretty good testament to the industry.
Well, and I also, believe, and I think it's been proven, the life insurance companies that have been successful in this business for many years, as well as the structured settlement brokers who have been successful for many years, that's not because of commoditization. That is because of the points you just outlined.
Interesting. Well, Brendan, how does this, we'll call it low interest rate environment, impact what we're talking about here today? And interest rates generally, how does that all impact what you're talking about?
Yeah, this may be heresy with respect to some people, but I think the absolute levels of interest rate don't have an impact on what we're talking about here today. It's really the slope of the yield curve. Mm-hmm. When you have it like it is today, positively sloped, that clearly resonates in everything we've been talking about. It's when you invert the yield curve that different strategies would come into play. But I think the absolute levels of interest rates don't matter. I mean, for example, for very large pension funds to be buying out annuities at this point in time sort of underscores the point that interest rates are relevant, and as long as the security provided by the annuity is there, people are willing to not wait for the absolute last basis point to pull the trigger. So I think yield curve is more important than absolute interest rates.
Well, you know, Brendan, that's a very valid point you're making. I've seen it in my own experience. Interest rates right now are low, and you'll get some people saying, and Bobby's heard it as well, I'm not sure I want to lock in right now into an annuity at these rates. If I keep my powder dry, keep my cash to the side, maybe when rates rise, I'll be able to do something a little different, more aggressive. The problem is, as we know in our business, that when people keep the cash off to the side, by the time interest rates rise, the cash is usually dissipated. It's usually been spent on something else. So human nature enters that picture. But even beyond that, Brendan, back in the 80s, when interest rates were at 12%, 11%, you remember this, Bobby, 10%, 9%, all of those interest rates, even at tax-free structured rates, I had the claimants and lawyers saying, no, I don't think those rates are quite high enough yet. We're going to keep our cash to the side. I don't want to lock in at 10% tax-free forever. I think we can do better. And so you see the folly in that. And in a relative world, having something secure as a structured settlement, even at fairly low interest rates, is a lot better than having nothing as you move forward.
Well, and that kind of supports, what you just said a few minutes ago. What about the flip side of that? Yes, people say, well, these interest rates are low. I'm going to wait until they rise. Well, how many years have the three of us heard that statement? I mean,
right.
That's been true the last 15 or 20 years. So you're exactly right. It's the relative importance of where we are at this moment, and the security that the structured settlement annuity brings, I believe, far outweighs the interest rate environment.
Absolutely, and I think the old adage that bears eat, bulls eat, and pigs get slaughtered should be the driving force here.
Excellent. I agree with you.
Brendan, I thought it was also extremely interesting talking about how Travelers' claim side, the property and casualty side, took advantage of the fact that their life company wrote structured settlements. Can you just talk about just a little bit about the synergy there?
Yeah, I think it was not an immediate synergy, but we grew into the point where we could converse on the same level. In other words, The casualty people are motivated by trying to get those claims off the books at a reasonable level. And we were able to work hand in glove with them to define what reasonable level meant. So to the extent we developed that kind of synergy, I think it benefited us entirely. And the program, I think, at that point in the Traveler's development was doing extremely well.
Well, I agree. Was it more important for your company from a workers' compensation perspective or a liability perspective, or were they equally as important?
Equally important, I think. Travelers wrote a fair amount of workman's comp, so, but I don't think they advantaged one versus another. Size was a factor, but no, I don't think so.
So both important, and of course the life company took both work comp claims and liability claims, which tend to be a little bit different, but when you put them together, they bring that smoothness of liabilities that we've already talked about.
That's correct.
Well, let's close with one final question, Brendan. I know a lot of our folks are going to be interested in this. Did you ever get any feedback from Warren Buffett or any of his folks about your article?
Gentlemen, if Warren Buffett reached out to me for advice, that would be ringing a bell, and I would get out of all the markets. So I think I've not heard from him. I don't expect to hear from him, but I'll admire him from afar. Well,
listen, Brendan, it's been terrific. We've enjoyed having you on the show today. If somebody want to get a hold of you, Brendan, and talk to you more about this, how would they reach you?
They can get me through email with Brendan Lynch at Ringler.com.
Okay. And Bobby, how about yourself?
Same, B. Steele at RinglerAssociates.com, or you can reach me anytime, 806-355-5008. I would welcome the opportunity.
Well, that's terrific. And, of course, all of you out there know that you can reach any Ringler Associate at RinglerAssociates.com. The website is terrific. A lot of great articles on the website. I wouldn't be surprised to see Brendan's article somewhere in that website as well. And all of you can also download any of the Ringler Radio shows from the Ringler website, or also from a couple of other sources, RinglerAssociates.com, RinglerRadio.com, or LegalTalkNetwork.com. And you can even download it from iTunes and listen as you walk through the park with your little headphones on and hear Brendan Lynch talk about pension liabilities and structured settlements. That'll make your day, right, Brendan?
Absolutely.
All right, terrific. So with that, Brendan, I'd like to thank you again for being our guest today.
I enjoyed it. Thank you.
And Bobby, thanks for being a terrific co-host.
My pleasure, Larry. Thank you for being the host of Ringler Radio and including me.
Well, thank you. And to all the rest of you out there listening, go out and have a great day.
The views expressed by the participants of this program are their own. None of the content should be considered legal advice. As always, consult a lawyer. Thanks for listening to Ringler Radio. With over 1 million listeners, Ringler Associates, the first name in structured settlements. Visit RinglerAssociates.com today.